Okay, let's talk about something that's been on a lot of our minds. We keep seeing these headlines, right? Super profitable tech companies are laying off thousands of people. And these aren't just any people. We're talking about experienced folks who helped build these companies from the ground up, all while everyone's talking about this new age of AI. It just doesn't quite add up. It feels like a paradox. So, what is really going on? Let's unravel this thing together.
Yeah, this is the big question, isn't it? If your company is doing great, why on earth would you get rid of the very people who made it successful? It seems to go against all common sense. But the answer, it turns out, isn't a simple good decision or bad decision. It's actually about these powerful, competing goals happening right inside the company. You see, to really get what's happening, you kind of have to stop thinking of a company as just one single thing. It's better to think of it as a tug of war between two really powerful groups with very different and sometimes clashing priorities. You've got your long-term investors on one side and your short-term management on the other. And boom, here it is. This slide just lays out that core conflict perfectly. On one side, you've got investors who are playing the long game, right? They want to know the company is going to be a stable, growing giant a decade from now. But on the other side, you've got managers whose performance is often judged quarter by quarter. They have to deliver profits, and they need to deliver them now. And that quote right there, it just nails it. These two goals can lead to completely different game plans. The move that makes your stock price jump this quarter might be the exact opposite of what you need to do to make the company a powerhouse in 5 or 10 years. So let's break down each of these viewpoints. So if you're an investor, experience is a massive asset. A mature team means better risk management, smarter decisions, and all that deep knowledge you just can't teach overnight. All of this stuff increases the probability that the company won't just survive, but will actually thrive for years. It's all about building a solid foundation, something that's going to last. Now, let's flip that. From the management side, they're not planting a tree for the future. They're trying to launch a rocket today. Managers are often laser-focused on what's happening right now. How do we slash costs this quarter? How do we boost profits for the next earnings call? From that point of view, letting go of experienced, higher salaried employees is a really tempting button to push. It's a quick way to cut costs and boost the probability of a short-term pop in the stock price. So you've got these two totally different goals, which lead to two totally different strategies. And this, right here, is where we get our aha moment, the big idea that finally makes this whole paradox make sense. It's called the probability trade-off. So what is this thing? Well, here's the crucial point. You can't always maximize both probabilities at the same time. An action that boosts your chances of a short-term win, like a huge profit this quarter, often lowers your chances of a long-term win, like being the market leader in the future. It's a trade-off. You're swapping one for the other. Now this table, this is great. It makes it crystal clear. Just look at that top row. If you keep your experienced people, the probability of steady long-term growth, that goes up. But the probability of a sudden quick profit spike, that goes down. Now look at the bottom row. Lay off that same staff and you get the complete opposite. The probability of that short-term profit spike shoots up, but so does the probability of making really costly mistakes down the line. Okay, so we get the what, this trade-off between short-term and long-term bets. But the big question is why? Why would a company consistently pick the short-term path if it puts the future at risk? Well, the answer, like it so often is in business, is all about the incentives. And it all comes down to this one simple, powerful phrase. In any big organization, people don't just do what's best in some abstract sense. They do what gets measured. To figure out why a company would risk its future for a quick gain, you just have to follow the incentive chain. And here's that chain laid out. Step 1, executives are judged on things like quarterly earnings and stock price. Step 2, their bonuses, their compensation, it's all tied directly to those short-term numbers. So step 3, they are naturally incentivized to do whatever it takes to maximize the probability of hitting those short-term targets. And that, step 4, often comes at the expense of the probability of long-term success. It's not a moral failing, it's a structural feature of how many big companies work. Now, I know what you might be thinking. This all sounds pretty cynical, right? Like every layoff is automatically a bad, short-sighted decision. But it's actually a bit more nuanced than that. This isn't really about good versus evil. It's about making a really high-stakes strategic bet.
So, when a company makes these layoffs, it's betting that the short-term savings will help it become a leaner, more efficient organization that's ready for the AI future. And that bet pays off if, and it's a big if, the new AI tools really do replace the work and the company truly emerges stronger. But that bet fails, and oh man, it can fail spectacularly if they lose knowledge they can't replace, gut their ability to innovate, and suddenly find they can't compete in the long run. And that's really what this all boils down to. When you look at these layoffs through the lens of a probability trade-off, you can analyze them not as automatically right or wrong, but as what they are, a calculated risk. It's a deliberate choice to sacrifice one kind of probability for another. Which leaves us with this final massive question for the age of AI. Is all that human experience, built up over decades, a company's most important asset that it needs to protect? Or is it now its biggest liability that it needs to shed? The way companies answer that one question is going to define the winners and losers of the next decade. Thanks for digging into this with me.